Okay.
Hi, everyone. We're just going to wait a minute or two until everyone can get logged in, and then we'll get started. Okay. Well, welcome to today's webinar. Before we jump into the presentation, my colleague Cynthia will share some details about the webinar itself.
Okay. Hi, everyone. My name is Cynthia Guerrero, and I'm a paraplanner here at Integris. If this is your first time attending a Zoom webinar, I would like you to know that we encourage engagement. On the toolbar on the bottom of your screen, you'll notice that there's a Q&A icon. As you have questions throughout the presentation, please feel free to ask Adam by clicking on this icon, and I will be monitoring as new questions arise, and I'll go forward and pass them along as we go. Quick disclaimer. This presentation is intended for educational purposes only and should not be considered investment advice. And with that, Allison, would you mind kicking us off?
Thank you, Cynthia. Welcome, everyone, and thank you for joining Integris Wealth Management's webinar with our presenter, Adam Schickling, today. For those who don't know me, I'm Allison Barrientos. I'm a partner and advisor here at Integris Wealth Management. Adam will be helping us make sense of what is ahead for the market and economy. He's an economist at Vanguard Investment Strategy Group. He's co-authored research on productivity, demographics, labor markets, and China's economy. He joined Vanguard back in 2012. Previously, he was a fixed income investment risk analyst in the risk management group, and he's a CFA charter holder and holds an MA in economics. Welcome, Adam.
Thank you, Allison. Happy to be here today. And yeah, I definitely want to have this as conversational as possible. So I please encourage everyone in the audience to either use the Q&A functionality, or if they want to speak up and have their voice in the recording, they feel free to do so as well. But I always find these things a little bit more enjoyable if there is some of that back and forth. I'll start just kind of going into it a little bit. I don't think it's surprising, but certainly the developments on the trade policy front are kind of front and center for us as we assess the economic landscape for the United States and really for the global economy as a whole. We've been increasingly monitoring and keeping track of developments on the trade policy, and I'll speak a little bit about the tariff rate and how we think about it, because I think it can be very hard to stay attuned to what tariff rates are, what they're being announced, what's being implemented, what products do they affect. We hear these numbers 10%, 140%, 50%, 25%, and it's kind of hard to contextualize what that actually means in the aggregate, right? So we look at what's called the effective tariff rate, which is basically if we take a weighted average of all the imports that come into the United States and apply the tariffs that have been announced to the select products, carving out the carve-outs that there are, for instance, and get basically the weighted average tariff that is applied to imports into the United States. Some of those imports are subject to much higher tariffs. A textile product from China, for instance, is going to be subject to a higher tariff than an automobile import, from Mexico that is still USMCA compliant. So I don't think one has to fully understand all the complexities to understand what tariffs mean for our growth outlook. It's best if we just look at it at that sort of effective rate. So for context, heading into this administration, in early 2025, the effective tariff rate for all U.S. imports, those are all imports coming into the United States, was around 2.5%. And most of that was a result of tariffs on Chinese imports or Chinese exports, depending on your reference, that were implemented during Trump's first administration. And those tariffs were maintained during the Biden administration. So there was, on average, the effective tariff rate for imports coming into the United States was around 2.5%. So you could kind of understand why we really didn't experience any inflation in 2016 through 2020 when those tariffs were initially implemented, because it was a relatively small magnitude of tariff increases. They were very targeted on specific trading partners, specific products, and it was also against a backdrop where the U.S. dollar was continuing to appreciate. And when the U.S. dollar appreciates, U.S. consumers face lower prices for imports. So, a Chinese import into the United States, when the US dollar is appreciating relative to the Chinese dollar, that means that import is cheaper for a US consumer. So you also don't feel the inflation from that dynamic as well. Now, after the Liberation Day announcement, when we were kind of at sort of peak tariff mode, that would have raised the effective tariff rate to almost 25%, which is roughly the highest we've had in the 1900s. Now, this chart compares on the left that effective tariff rate throughout time, and I think it's very helpful just to put that historical context. One thing I would want to caveat is we are, of course, given the technology and the technological development and the ability to transport goods is a lot easier than it was in the early 1900s. We are a lot more dependent on global trade, as is every economy in the world, than we were in the early 1900s. So if we went back to a tariff rate of 25% like we had in the early 1900s, that would be a bigger impact on our economy, because our economy is more connected to global trade than we were in the early 1900s. Even though relative to most developed economies, the US is still what we generally consider to be a fairly insular economy, meaning roughly 2/3 of economic activity in the US is within the US borders. If you were in a country like China, Australia, Europe, Canada, those numbers are a lot lower. So the US is generally still a pretty insular economy, but of course, we get a lot more things from global trade than we did in the early 1900s. Now, after the Liberation Day, we saw a very strong market reaction. There was a little bit, the administration backed off a bit on some of the tariff announcements. And we've come down since then to where we're now the effective tariff rate is closer to around 17.5% for the average effective tariff rate. Still a very large increase from that 2.5% we were at to start the year, not as bad as the 25% that we were looking at post-Liberation Day. And ultimately, we expect it'll probably come down a little bit more throughout the course of the year due to trading negotiations that are ongoing between major trading partners, et cetera. There also are risk factors depending on how courts rule about tariff impositions. But we expect the effective tariff rate will end the year kind of somewhere around that 12.5% to 15% ballpark. So that is still, again, a sizable increase from where we were to start the year. That would be the highest tariff rate that we've had since the 1940s, but it is not as necessarily alarming and damaging as we might have seen after Liberation Day, and certainly what we experienced following the Civil War in the early 1900s. Now, the effects of that, are kind of complicated. Obviously, the higher the tariff rate is, we would expect there to be a bigger drag on U.S. GDP, so lower economic growth in the United States, particularly in the short term. I mean, the argument is in the long term, it spurs business investment within the United States. You have nearshoring, you have onshoring, et cetera. Those arguments are probably, weak at best. But in the short term, those tariff rates are a headwind for growth. They slow the economy and they raise inflation. Again, it's one thing to not necessarily feel the direct impact on consumer prices when the tariff rate goes up to 2.5%. It's much different when that tariff rate goes up to 15, 16, 17%. So, that's kind of the high level assessment, obviously, of how that would affect theoretically growth and inflation. But it is not a perfectly linear relationship. An 80% tariff on China does more than 4 times the damage a 20% tariff does on China, because you reach a point where it essentially is an embargo on that country. You are limiting trade between those countries almost entirely, and then there starts to be adverse consequences, that kind of secondary consequences that build on top of that as well. And that's kind of also what we highlight in our second page, which is the amount of revenue that we will collect on tariffs, which is important because the revenue from tariffs is viewed as a major offset to what will be a deficit increasing tax bill. The big beautiful bill will increase the national deficit, regardless as to whether you use dynamic scoring or static scoring. And one of the ways that the administration has said they could alleviate that would be the revenue from tariffs. But tariffs are not static either. And again, if you implement a 20% tariff, you're probably going to make more revenue than if you implement an 80% tariff. Because as you raise that tariff level, there starts to be more substitution of goods. There starts to be more substitution or rerouting of trade. So if we make Chinese imports 20% more expensive, okay, we bear some of that cost. The importer, the Chinese producer bears some of that cost, but the overall volume is probably relatively unaffected. And then you have 20% revenue generation on those imports. If you implement an 80% tariff on Chinese imports, that basically stops trade altogether by and large, and then you have no imports to tariff. So there is a dynamic element to how much tariff revenue is collected based on how much those tariff rates are set at. Now, the other aspect of how the tariff developments will affect growth and have manifested in a lot of different, I think, both in the financial market side, but also what we're seeing on a lot of the sentiment indicators from consumers and businesses, which is tariffs create a higher level of uncertainty. There is a higher level of uncertainty right now in terms of where tariffs will be in 3, 6, 9, 12 months. That uncertainty wasn't there 3 years ago. It really wasn't even there 7 years ago. And that is making it a little bit more challenging for businesses and consumers to plan for the long term, particularly on the business side of the equation. Right? Businesses are a little more reluctant to borrow money and to expand, to invest in their business. They want to wait and see how trade policy plays out. So uncertainty in a theoretical framework can constrain growth because it is basically challenging the decision-making process that businesses and consumers have to do on a daily basis. And when you are unable to make those long-term decisions, then you are unable to optimize in the short term. Right? If I'm unable to know, or I can't even form a reasonable expectation of what's going to happen in a couple of years, it's very hard for me to operate at my full potential in the current environment, particularly on the business side. And what we saw in that was equity markets started to price that in as well. We saw with the EPU, which is the tan line, yellow line on this chart, that is the Economic Policy Uncertainty Index. And I won't go too far into how we measure that, but it's basically a collection of sentiment analysis in journalistic outlets. It's also a comparison of how divergent are economic forecasts, because in a more uncertain environment, we'd expect there to be a bigger range of disagreement on growth, inflation, policy, unemployment rates, et cetera. So that line has spiked noticeably. We've seen there an uptick in the policy yield, or we've seen an uptick in economic policy uncertainty. And then if we compare the CAPE yield minus the real 10-year treasury, which is basically an estimate of equity risk premium, we've seen that historically does follow to an extent that policy uncertainty. So basically the short end of that is when there is more policy uncertainty, equity investors demand a higher equity return because there's more risk. In the short term, that generally means you have downward pressure on equity prices because that's how you push the expected equity return into the future higher. So this is, we've seen this before time and time again in terms of equity markets. Generally, an equity market, for there to be a correction or sell-off in the equity market, you see an increased level of uncertainty that could be either derived from policy or it could be derived from economic fundamentals. So we had a lot of uncertainty during the pandemic. We had a lot of uncertainty during the GFC. We didn't know who was going under, what mortgages, what banks held, whose mortgages were in good condition, et cetera. You have sort of late stage business cycles, which is, traditionally where you have full employment, your economy is kind of starting to sort of plateau. And then lastly, you have elevated valuations, which are always a risk factor for a correction, considering you just don't have that buffer to the downside like you might have in a more reasonable valuation environment. And we've also seen this risk premium play out in the Treasury term premium, which is the demand investors ask for, which is the yield investors demand to own long-term bonds. So if we think about the long-term interest rate, it's essentially an expectation of where the short-term interest rate will be over that prolonged period of time. And there's an element of risk added, there's a yield added to it to compensate for your term premium, which is to say, I'm owning a longer term bond. I'm taking on more risk by owning a longer term bond versus owning a collection of shorter term bonds. I want to be paid a risk premium for owning that longer term bond. And when we become more uncertain about the long-term growth environment and the inflation environment, the term premium for an investor to own a long-term bond goes up, and we've seen that as well. And that's one thing that has made the challenge. As much as the administration may think that they want the Fed to start cutting interest rates, if you cutting interest rates on the short end of the curve is going to often do very little to affect the long end of the curve. If anything, it probably raises that term risk premium. So the long end of the curve is where policymakers care more about, because that's what affects mortgage rates, which their consumers are going to, which their citizens or their constituencies talking to them about. It's also going to affect business investment. And cutting short-term rates is only one small component. Short-term rates are only one small component of what long-term rates do. The other element is term premium, which is a function of how confident is your fiscal trajectory. And right now we're dealing with the deteriorating confidence in the U.S. fiscal trajectory. Now, I mentioned the valuations on the U.S. side. This continues to be a point of caution for us. There are pockets of the U.S. equity market that are a lot more attractively valued than others. But across the entire index as a whole, U.S. equities are in that 95th to 99th percentile of historical valuations. On top of that, this line, which is the dark line, is that CAPE, which is the cyclically adjusted price to earnings ratio. So that is how much are you paying per dollar of earnings. And the light blue line is the fair value CAPE. And the fair value CAPE is essentially what we think that price to earnings ratio should be relative to economic fundamentals. And you can see that fair value CAPE line has actually decreased over the last 4 years. And the reason why is because interest rates have risen. And when interest rates have risen, that is going to raise the discount rate that you use when you're discounting future equity earnings. So when you are discounting future equity earnings, the higher the discount rate, the lower the present value of those future earnings will be, which means in a higher interest rate environment, we would expect valuations to move lower. And in a lower interest rate environment or in a declining interest rate environment, we would expect valuations to move higher. So the valuations are largely where they're at, where they've been over the past couple of years. I mean, we're still kind of above 2019 levels of valuations, whereas the fair value range for those valuations has deteriorated because of the attractiveness of owning fixed income. Now, that's on the U.S. side, but we do still see opportunities in pockets of the U.S. like U.S. value, U.S. small cap, and we also see attractiveness outside of the United States as well, which this has been the first start to a year in a long time where international has outperformed U.S. In fact, it's crushing U.S. equities right now on a U.S. dollar denominated basis. And when we look over the next 10 years, the probability of U.S. outperforming international in our forecasted of distributions, only 33% of scenarios has the U.S. outperforming international. 67% of scenarios, international outperforms the United States. And the outperformance that we've seen from say 2012 to 2024 in international equity, in U.S. equities, where U.S. was outperforming international stocks by 9 percentage points a year. Mathematically, that's just near impossible to see anything like that continue into the future. So for investors that we might speak with that say, well, I have a home bias, and I understand for a number of reasons why that might be the case, you still might want to think about just moving that portfolio allocation slightly more back to a more neutral or less home bias position, because the likelihood of experiencing another decade like the one we've experienced the previous 10 years is extremely, extremely low. And there are pockets of the international market that are looking relatively attractive right now that investors might want to consider their exposure level. Now, I think one thing that does get misunderstood when we look back at the U.S. outperformance of of the last 10 years. So from 2015 to 2025, where US equities returned almost 12.5 percentage points annualized, and European or international equities, excuse me, were around 4 percentage points. So that's where we saw that significant outperformance from US equities. Part of it came from valuations. About 35% of it was attributed to, at the time, during that time period, US was paying higher dividend yields than international competitors. And we saw US valuations expand more than the expansion that we saw for international valuations. So that's a return driver. But almost 2/3 of it actually came from the strength of corporate earnings growth in the United States. And corporate earnings growth, earnings being the denominator in that price to earnings ratio, corporate earnings growth in the United States was so strong in large part due to the revenue growth. So there's two ways you can grow your earnings. You can increase your profit margin or you can increase your revenues. And a lot of the US firms really saw really strong revenue growth, and there was, to a smaller degree, profit margin change. So the US outperformance of the last 10 years has been fundamentally driven by the US corporate outperformance relative to international peers. It's not just a valuation story. It's not just a US dollar story, although those things did contribute to it. It is the fact that US corporations have considerably outpaced their international peers when it comes to earnings growth. And there's a whole litany of academic research into why that might have been the case. We don't really expect that to change going forward. I'm jumping around a little bit, but I like to showcase this because when I talk about US versus international, I'm generally met with a little skepticism because we are generally, as a whole, more bullish on the US economic performance than our international peers. I mean, we are a well-positioned economy for the next 10 years, much more so than Japan, much more so than Europe, much more so than Canada. And it can be challenging when I talk about owning these European equities where we think of the European economic growth as being kind of stodgy, 1%, low growth, low innovation, et cetera. But I equate it to sort of being two runners racing in a hurdle race, and the one runner having a much higher hurdle than the other, even though they're a faster runner. The US is going to continue to out-earn its competitors, out-earn its international peers. That's this negative 2.8% figure that I show here in the chart. So that represents our view that US corporate earnings per year will be run about 3% higher than international peers. The problem is you have two big disadvantages as a US investor. One, your dividend yield is considerably lower than international dividend yield. So US equities are paying a dividend yield of 1.5% less than international equities. That's a historically large dividend yield disadvantage for US equity investors. And two, the US valuations now are around trading 50-60% premium to international equity valuations. That's a historically large valuation premium. So what we would expect to take place is, even though the US continues to outperform from a fundamental standpoint, the valuations converge. They don't converge entirely, but they do start to converge, and you are picking up that extra return as in the dividend yield component. And you couple all that against the backdrop of what we believe will be a weakening US dollar. And if you're a USD investor and you're buying international stocks and you're not currency hedging, because we don't recommend to currency hedge international equities, then when the US dollar depreciates and you bring those international earnings back, you're getting more US dollars. So the US dollar depreciating is a tailwind for a US dollar investor who is investing in international equities. So those are the three positive contributors. And that's why the expected return differential for international is around 7.2% relative to 5.4% for US equities. The other thing that I think is notable in the US space is a lot of the revenue growth that has occurred. And these charts can be kind of hard to interpret, I think. So I'll just kind of speak to it because I think that's sort of more helpful. When we think of why has US corporate revenue been stronger than international corporate revenue, it's not that direct comparison companies have seen a marked difference. So if we compare, Hershey's to Mars, like chocolate to a US chocolate company or a confectionery company, what do we call it, to a European company in the same industry, or Boeing to Airbus, or any of these firms where you kind of have similar companies but in different domiciles. It's not that the US company has massively outperformed its competitor. the real reason for why US corporate earnings growth has been so strong relative to its peers is because of the new entrants into the equity indices. So the US has had a dominance on a lot of the new sectors that have contributed considerably to US equity return performance. That I don't think is unintuitive. We've, a lot of the technology giants of the last 10 years have been formed in the United States, or at least their formative years were in the United States, or they've grown materially since coming to the United States. I mean, there's a few international technology companies, TSMC in Taiwan, the ASMR, I forget the other chip design company, or the company that designs the machines that build chips. But the technology space as a whole is incredibly dominated in the United States. And there's been stats that have circulated in the past that have kind of shown this. The number of billion-dollar companies that have been created in the United States versus Europe over the past 15 years, it's like 30 to 1. I mean, the US has just led the wave in entrepreneurship. And that's part because of the economies of scale and the sort of regional dominance that Silicon Valley has in that sector. And this is this is where you could say, okay, is this going to continue? Is the US going to continue to have such a strong advantage in the technology space? On the one hand, we have the institutional knowledge, we have the infrastructure, we have the human capital. On the other hand, other countries are aware of this. They understand what has been the shortfall in their productivity growth. Europe knows that the reason why their GDP per capita has grown considerably slower than the US since the global financial crisis is because they do not have a technology hub. And they're kind of interested in achieving that. So there are going to be headwinds that the US having this continued dominance in the sector. It's probably not something that will change imminently. And it's more reason to believe that US corporate earnings growth will continue to outpace international peers. But I do think it's stark. The idea that I sometimes get from people is they think that just the average US company is more productive than the average European company. And that's really not what's happening. You just have a few of the really, really productive, high value add companies that have been created over the past 10, 15 years. A large portion of them happen to be created in the United States. And that drove the overall equity market. And whether that continues or not is going to be a key determinant of where US equity performance ends up in our scenarios relative to international equity performance. And then this slide here, and I don't know if I've seen any questions, Allison. Has anything come in or?
None yet. And I will jump in if we do receive any.
Okay, perfect. And then the other thing I've talked about, but just to showcase, is this component of the US dollar being also a very important driver of a USD investor's experience investing in international equities. This was really prominent in 2023, where we started to see in a domestic currency sense, international equities were doing quite well, but for a US dollar investor, they weren't doing well because the US dollar continued to appreciate. So then you were bringing back those international earnings and you were getting fewer US dollars because the US dollar had appreciated. So generally speaking, when you see periods of time where international is outperforming US, from a USD investor perspective, it's generally going to be accompanied by a period of USD softness. I mean, it doesn't have to be mathematically, but generally speaking, you see that trend where when the US dollar is weakening, international stocks are outperforming, and when the US dollar is strengthening, international stocks are underperforming. So predicting the US dollar and predicting currency movements is always really challenging to do. I think a lot of the movement that we've seen in the US dollar thus far has really been sentiment driven. It's not necessarily driven by fundamental interest rate differentials or productivity differentials, but the sentiment has certainly evolved. And there's been rising questions about just how severe or just how big dollarization will be in the global economy in 10, 15, 20 years. And the administration has also implicitly stated a goal at parts that, the dollar strength is a challenge for the manufacturing sector, and it's a challenge for certain parts of industry that they want to be mindful of. So the age-old joke is a strong dollar good or bad? Well, it depends. It has pros and cons. But if we look where the US dollar is now, based on fundamentals alone, it would suggest to us that the US dollar will modestly depreciate over the next decade by about a percentage point a year.
I have one question for you, and it relates to some questions that we've been getting from clients. As it relates to the US dollar, what do you see as the impact of the rising popularity of cryptocurrency, and in particular, this administration's enthusiasm for it?
Yeah, I mean, so I'd say I think there's a couple things. I mean, the demand for crypto certainly is seems to be much more driven from an investment lens than a currency lens, right? And I do believe fundamentally a currency can't be an investment because a currency needs to be a store of value is certainly being one sort of core component of a currency, but it also sort of needs to have a stable value element to it as well. I mean, now there are these stable coins that are coming about, but I'm still not quite sure the advantage of owning a stable coin compared to putting US dollars in a money market and collecting a 4% interest rate versus, I mean, some of the most profitable companies in the world right now, like Tether, they're basically getting to, lend at the rate of 0 because they're not paying anything on the stablecoin reserves. And then they get to take the holdings and float them in a treasury money market and earn 4%. So the float they have would make Warren Buffett jealous. So I don't think that that's where the threat to the US dollar comes from. That the reason I think why we've seen such strength in the US dollar is because there really hasn't been viewed a prominent substitute to it for quite some time. If we think back to those periods where the US dollar did weaken, like in the 1980s, I mean, we thought Japan was going to take over the world essentially, and the Japanese yen was going to be the future of global currency. And then Japan had a commercial real estate bubble and spent a decade kind of in the doldrums. And then in the early 2000s, well, it was okay. The euro, I mean, this is perfect. All these countries in Europe signing up for the euro, that's going to become the global reserve currency. And then you saw the euro appreciate relative to the US dollar. And then when that crashed post GFC, it was the Chinese RMB. Okay, well, China's China's growing at 5-6% after the global financial crisis. This is they got One Belt, One Road initiative. Clearly, it's going to be the RMB in the future. And then we saw 2015, 2016, this growth slowdown in China. And then all of a sudden, we weren't concerned about the RMB being a replacement. So I don't view really there being a viable near-term substitute for the US dollar that threatens its sort of reserve currency status. And you can have, I do think you can have some modest depreciation without there being a considerable threat to the US dollar's position as a global reserve currency. But there can clearly be some de-dollarization, which means dollars are used in less global transactions than they are currently used in. Honestly, I've kind of been surprised just how many global transactions are still done in US dollars. But I don't think that's going to transition to a cryptocurrency or anything like that. And I'm not even, I don't own any cryptocurrency, but I'm not particularly like anti-crypto as an investment. I mean, I think that, I think that it has reached a sort of critical appeal as a collectible. I mean, there's art that people invest in. There's fine wine that people invest in. The fact that it has no tangible value, I don't really view as being that relevant because there are a lot of things that have no tangible value that we still invest in. If you bought when you propose to your wife, if you bought a cubic zirconia engagement ring and told her that you felt diamonds were artificially inflated from a price standpoint, I don't think that would go over very well, right? So we still associate value to a lot of things that don't actually have intrinsic value. But that's my own personal opinion on crypto. Again, I don't own any, mainly because I'm afraid I'd forget the password and then I would lose all my crypto, or I'd throw out my computer by accident and end up in a landfill with some crypto money on it.
That's helpful. Thank you.
And the last I'd hire is that, this era of high interest rates, we don't believe this is a transitory thing. And, this has been a challenge, I think, I think it's an understated aspect of the transition that we've gone through. We were so used to very low long-term interest rates, 3%, 3.5% mortgage rates, following the global financial crisis. And we don't see that returning. We do expect long-term rates will remain elevated. We really don't see much fundamental reason for why the 10-year should be below 4%, which puts mortgage rates, makes it challenging for a 30-year mortgage rate to go below 5.5%. And that's going to create this sort of odd transition period in the economy. I mean, you have firms that will increasingly have to roll over debt that they previously took out at 1-2% during COVID, and now they have to pay 6-7%. You have households that are dealing with this challenge every day. It's how do I move in, and we have studies that have shown this, that basically you have a lot of people that are in what they traditionally would have defined as their starter home because they are not able to upgrade to their forever home because they would be foregoing a 3% mortgage for a 7% mortgage. And then as a result, you don't have starter homes opening up for all the young people that want to buy a starter home. And it's kind of creating this bottleneck in the housing market. That's a big challenge for mortgage rates to go from 3 to 7 and housing prices to go up 60%, right? That kind of defies traditional asset pricing models. You'd expect that when interest rates go up, the value of the house goes down due to that discount rate component. But it's been a very weird housing market over the last 5 years. And we've also dealt with the lack of supply coming out of the global financial crisis. But I think this is an element of, this transition from a low to high interest rate environment. Thus far, it's been relatively painful, right? You got to keep in mind that if you would have asked all the world's leading economists in 2019, can the U.S. economy survive at a 5% Fed funds rate? They would have said no way. And they would have thought that we would be in a depression. And we're now at 4.5%. I mean, it's really not slowing anything down from an economic standpoint. And we were at 5. So it's on the one hand, it's been remarkable just how painless that transition has been, in that we didn't have a recession, we didn't have an increase in unemployment, we didn't even have financial asset prices normalize. But on the other hand, it's how long does that continue until there is that resetting effect and that repricing effect that hey, we're not in a 2% 10-year interest rate environment anymore, and it's unlikely we will be back in that environment for a very long time, if ever. I mean, that was kind of the historical anomaly we tend to forget. 10% 10 years at 2% what was the historical anomaly. We are now much closer to the historical average of long-term interest rates.
Yeah, and I think some of us are old enough to have remembered what interest rates were back in the 80s and when they were in double digits. But I think certainly the comments that you made around the housing issues related to it, we're certainly seeing in the Monterey County area, with housing prices remaining the same and the interest rates on new mortgages being so high. Quite a few people are just staying where they are, keeping that 3% interest rate, and making it difficult for new starter homes.
Yeah. Absolutely. So I'd love to open it up to any other questions on the call.
Yeah, we did have one question come through about what your outlook on gold is, and it's currently at almost $3,400. What are you thinking there?
Yeah, so we really don't publish outlooks on commodities because it's a very small area for us as a firm. I think again, similar to how I mentioned those other intrinsic or non-intrinsic investments, right? It's kind of hard to mathematically derive an estimate on their forecast. I mean, a lot of it is sort of based on expectation of future demand, and so I really couldn't tell you, what we have if we have. I mean, we don't have a forecast on gold, just to be blunt. Now we have been increasingly more, I think, communicative of the role commodities can have in a portfolio as a whole. And that's a little bit of a deviation, I think, from the historical Vanguard ideology. And largely, we saw it during the pandemic recovery, that if you are an investor that is concerned about unexpected inflation, because equities do well with expected inflation, even bonds to an extent. But if you are an investor that's concerned about unexpected inflation, then commodities are kind of one of the best ways to get exposure to that. Now, you could say, well, you could also own inflation protected bonds like TIPS. The problem is inflation protected bonds only have a 1-to-1 beta with inflation. So if inflation goes up to 5%, it's only it's matching that. So like let's say in a scenario where you want to protect 35% of your portfolio from an unexpected inflation surprise, well, you could buy 35% of your portfolio in short-term commodities, but that's a significant portfolio reallocation. Or considering that commodities have a beta of almost 7 to 1, you could put about 5% of your portfolio in a commodity sleeve, and that would essentially protect almost 35% of your portfolio from a spike in unexpected inflation. So, while we don't talk about commodity forecasts, and it's not a significant area for us as a firm, we do acknowledge the value it can have in certain portfolios depending on an investor's objectives.
That's actually a really interesting point about the inflation protection and the 5% allocation. Thank you for sharing that. There were a couple of points that you made that I thought were particularly valuable, so I thought I'd just summarize them. You talked about the US being so well positioned economically relative to our international competitors, but also about the headwinds of high US valuations and lower dividend yields, as well as a weakening US dollar. It speaks to a really, really strong case for global diversification, despite the fact that the US is well positioned so economically. I thought that was a really key point, and something that not necessarily is particularly intuitive. I also thought that the graph showing the increase in economic uncertainty was particularly interesting. I think a lot of investors have felt the uncertainty and the corresponding concern for their portfolios, but to see it really represented numerically and to see the comparison to the last period of really high spiked uncertainty being the global pandemic was actually really affirming, I think, from an emotional standpoint. So I think those are two really key takeaways for me. One additional question that we do have is, will the size of the growing federal budget deficit and rising interest on the debt eventually cause us serious harm? What's the likely long-term prognosis there?
Well, I think short answer is probably, so we often say with COVID, it didn't really, a lot of trends that we've seen since COVID were really trends that were already in the works. They just were accelerated from COVID, right? So the whole transition to work from home, I mean, that was very, very gradual, but it was kind of slowly building. And then COVID just basically truncated that into a 3-week window. Even some of the dynamics around globalization and nearshoring and supply chain risks, those were things that had been building, and then just COVID suppressed it. With the debt is another thing, because we were clearly facing very challenging long-term fiscal trajectory in the United States, because we have these entitlement programs is a large part of it that will become increasingly expensive as we age and as we have more people claiming benefits. And we haven't really increased on the revenue side of the equation. So we are going to be spending more money on Medicare and Social Security, and our revenue growth from those taxes is growing at a much slower rate. And that was just sort of mathematical. I mean, you could maybe hope and pray that, well, if we can solve Alzheimer's and we can solve cancer and we can solve diabetes and we can solve, dementia or whatever, then our Medicare costs will fall 20%. But, realistically speaking, healthcare is very expensive when we age. And a lot of what we spend on healthcare is spent in the last 12 months of our lives. And Social Security too, I don't think it's really understood as much, but the Social Security benefits in the United States, particularly for like upper middle income workers, are very, very generous compared to retirement pension benefits in other developed economies. So, we have, I think in a couple of years, there will be the max earners in Social Security will be collecting almost $100,000 a year between two earners when they're retired in Social Security benefits. So that becomes very expensive. Now the question is, okay, when is there a breaking point? And we tend to look more at the deficits than the debt. So there's a lot of talk about 24 trillion in debt, or debt 100% of debt to GDP. We don't think the debt level in and of itself is actually very predictive in terms of when there is some type of, I don't want to use financial crisis, but some sort of fiscal crisis, which is where all of a sudden markets start paying a lot more attention to your fiscal trajectory and you start to see interest rates rise considerably and there becomes declining confidence in the currency. Right? That's a fiscal crisis. Happens a lot in South American countries, happens very rarely. It's, hasn't really ever happened in the United States before. But the debt level as a whole, we don't think is actually very important. What's more important is what we call the structural deficits. And the structural deficits are the deficits that you are running, ignoring spending that is done in a recession or the decreased revenue that happens in a recession. It's the spending that is done on structural programs that are in the government budget. Health, Medicare, Social Security, Medicaid, defense, et cetera, right? These are all things that are, pretty challenging to considerably mitigate, at least politically. So the structural deficits as a percentage of GDP, they're on pace to reach, 7% deficits of GDP just based on structural spending in 5 or 10 years. And that's going to be dependent upon all sorts of other developments in the near term, like the tax policy and the revenue we have from tariffs. But that is reaching a point where we think historically you start to see considerable upside risk, considerable downside risk sort of to the fiscal sustainability and considerable risk of a fiscal crisis. And normally it generally takes some sort of crisis event for governments to sort of push their way to act. Largely what we found is, there's a few ways, if you think about theoretically how a country can improve its fiscal trajectory. The first, most logical, but most difficult politically is you raise revenues and you cut spending, right? The second is you engage in financial repression, which is you essentially keep interest rates very low on the short end of the curve, so that way you can afford to run high deficits. This is what Japan has been doing for a very long period of time, because the Bank of Japan does not have independence like the Fed does. So the Bank of Japan has kept rates very low in order to subsidize and to support Bank of Japan spending. This was also what the Fed did back following the World War II. There was really no such thing as Fed dependence following World War II. The administration said you need to keep long interest rates low because we are getting ourselves out of this debt that we had from 2 global conflicts. And if you look during that time period, post World War II, short-term rates were about 25 basis points. So that's called financial repression. The problem with that is you're obviously sacrificing your monetary policy independence, because the monetary policy is then a function of what policymakers need, and you're also you're constraining investors and savers, and you're creating a distortion to the level of interest rate, which has effects to long-term interest rates. The other is you grow your way out of it, which is you have nominal GDP growth that is outpacing nominal debt growth. It's kind of hard to grow your way out of it when your debt is increasing by 7% a year as a percentage of GDP. It's one thing if your debt was growing at 2%, but it's another when it's 7%. So that's not very likely. And the last option is is basically you inflate your way out of it. You let inflation run higher. And as a result, when you're a debtor and inflation runs higher, then your real debt starts to decrease relative to your GDP. And the latter, the inflate your way out of it, is the avenue that most countries have historically taken. But that and financial repression, you really don't see much of the other two. The whole action, being prudent and cutting spending, and the other one, which is the growing your way out of it. So, this all is our view supports the idea that longer term inflation is going to be higher in the United States. Now, that's not saying 6-7%. We're saying 3%. But that is a different inflation environment than what we experienced since the early 1990s. So we do think that it's one reason for why we would expect long-term inflation to move higher, because of that's being a primary mechanism that the country will utilize to sort of rein in its debt levels.
And if you think long-term inflation will be higher, as an investor, what does that mean for their portfolio allocation long-term?
So it depends how that happens, right? And if it's just a sort of gradual higher long-term expectation for inflation, which I think we are seeing to an extent, then it really doesn't have significant implications on the asset return side or portfolio implication side, because realized or expected inflation, you see that price into interest rates. So bonds start to pay higher yields because they have a higher interest rate or a higher inflation component. Equities do, perform okay because equities are based on real corporate earnings, not nominal earnings. And something like commodities, of course, does decent. I mean, because it's capturing that inflation dynamic. If it's instead achieved via periods where there's a year of 7% and then a year of 2%, if it's a more volatile trajectory, then that becomes more challenging from a portfolio allocation standpoint. I think it's one reason why equities still have a considerable weight in a portfolio regardless of age. But then we might be thinking about a larger portfolio allocation in commodities or something like that. It's tough because historically commodities have been a very poor return generator for a portfolio, right? So you look at the 20-year return for a commodities fund, it's pretty atrocious. But there are fixed income products and things like that you can have a greater allocation in, that again they have a lower beta to that surprise inflation, but are giving you protection in those years. So it kind of just depends on how that inflation trajectory plays out. Tend to think it's probably going to be a bit more of a sort of just gradual upward movement in those long-term inflation expectations, which then gets baked into your future asset prices. But when you transition and you're going through that period of resetting those expectations, we would expect to see some volatility in the equity and fixed income markets.
Yeah, and I think when there's volatility, that really speaks to making sure that your overall allocation between stocks versus bonds, those bonds being those more stable assets, is really important. So making sure that we're focusing on the fundamentals of why we're selecting certain asset allocations for particular investors, given their time horizon and cash needs from the portfolio.
Mm-hmm.
Yeah.
Yep, absolutely.
I don't believe we have any additional questions that have come through. Adam, is there anything else that you wanted to share before we start to wrap up?
Nothing else on my end.
Okay. Well, thank you so much for your time today. I appreciate your expertise and your willingness to break things down into really digestible components. I'm sure I'm not alone in saying that I'm definitely walking away with a few gems of information. For everyone in the audience, thank you all for your time today. We hope that you all pulled some valuable insights from your time with Adam. And we look forward to the next time we can do a webinar. Take care, everybody, and enjoy the rest of your day.
Thank you very much.
Thank you.